Meantime, Diamondback Energy soaring over 9% today after the company announced plans to merge with fellow Midland-based, Texas-based company Endeavor Energy Resources. The cash and stock deal is valued at $26 billion, including debt, would make the company the third biggest oil and gas producer in the Permian Basin behind Exxon and Chevron. Here to go inside this deal and other possible M&A targets, Paul Sankey, president of Sankey Research. Paul, always good to see you.
Hi.
So they really had to fend off competitors to win over Endeavor.
Yeah, that's right. I mean, how often do you see a company go up 10% on announcing a deal that's going to issue? It's a 60-40 stock deal, so it's a lot of stock is going to come. Obviously, you'd expect Diamondback to trade off on this because of the issuance, but in fact, the stock went up 10%, telling you how much the market and we love the deal. It's a great deal.
What does this tell you about other assets that are available for sale in the Permian Basin, and who else might go after them?
Well, there's definitely less and less people on the dance floor, as you know. I mean, obviously, Pioneer was a top asset. Endeavor, we knew that Exxon were looking at it. We knew that Shell were looking at it. So this is why it's such a big win for Diamondback. And I think they've got this win because they're based in Midland. They're a very low-cost operator, and attractive to Autry Stevens, the owner of Endeavor, because they're a local player. So it's a unique opportunity for Diamondback with such good operations. I think they'll do very well. You then get into Devon, you get into Ovintiv, you get into Marathon Oil. Those are the names that really still look like they've got to do something. We think these companies have to get bigger to get higher multiples. Diamondback's done that today. Devon's rumored to be, or at least reported by Reuters, to be buying Enerplus in the Bakken, which is not a deal we like as much because we want everyone to concentrate on single areas. And then Ovintiv and Marathon Oil is very much an open question.
So when you look at the U.S., Paul, where we are outproducing the Middle East on oil per day, per barrels per day, it seems like the story has gone from let's trace oil with a Chevron or a Exxon Mobil, and now let's go to the M&A cycle of the story, because these deals don't necessarily have to have crude moving higher, which is probably a better spot for an energy investor to actually have some appreciation of the worth of the stock. So is that the process that we're in right now, where we're just trying to pick the next takeout candidate versus the move in crude? Because it doesn't seem like that's going anywhere.
Well, the whole takeout trade has been completely upside down, because what you've seen is companies have sold themselves for no premium, often because the CEO is cashing in. That's not good for shareholders. This one's another example of that, because Diamondback has gone up on the deal, obviously, and Endeavor's not quoted, so there's no movement there. But essentially, it's been a bad oil tape for people who are hoping to get taken over, because you haven't seen any premiums. Having said that, the boring good thing about this tape is that we're at $80 Brent. The big oils, the Chevrons, the Exxons, are paying out the most they've paid out in their history, including 2022, which was a crazy year for prices. And so what you've seen here as well is the exploration of production companies blew out their cash return and returned to shareholders in 22 and are now falling off. These bigger companies that have emerged, which would be Exxon, Chevron, Conoco, and now Diamondback, are all actually ramping their cash returns. And they're ramping them, as I've said before on this show, to a point where they're outright attractive against any stock in the market, which is what we've been waiting for. And we judge that as a 10% sustained cash return to shareholders. If you have a 10% cash return to shareholders sustained, your basis is returned to you within 8 years, at which point you own an option on the future of oil, and we think that's a great option to own. So it's not a near-term trading call. It's a long-term structural attraction that you see Warren Buffett buying into Oxy. We know why.